Hello, everybody. So this is just going to be a super quick video and an overview of what we're trying to accomplish with this business and kind of give you some details about our thought process and how we go about making these decisions. So first off, just to introduce who we have making decisions for this company. First off is myself, and second off is my father. So I have a background in mechanical engineering, and I've spent a lot of time doing data analysis and research. In addition to that, I have 12 years of experience investing. My father, who really taught me a lot of what I know, has 50 years of experience. And I'll talk about this a little bit later once we get into the psychological parts of it. But I really believe that experience makes a big difference with investing. So a really high level of how we work is first we need to find some monthly amount that you can invest. And that could be something quite small. It could be something a little bit larger. So just to give you an idea, I am willing to invest very small amounts, even if it's $20, $30, $40, $50 a month. But we can also invest larger amounts. But one thing that's very important is we need to have a cash buffer. We need to have an emergency fund. And the reason that we need that is for unforeseen circumstances. So we cannot be in a situation where there is a market downturn, which there definitely will be some in the future, and we need to liquidate some of our holdings. That is the worst case scenario, and we need to avoid that. So what we're going to be investing in is basically 3 different sleeves, which my father and I work together to pick out different companies and ETFs. And at a high level, it's defensive US companies, growth companies, which is usually going to be tech and AI companies, and aggressive companies, which also are going to be in the tech space, but they're going to be a little bit more speculative in nature. And this really is very dependent on your risk tolerance. So when we sit down and talk and look at what goals we want to accomplish, we're going to take into account the goals, the position that you're in, and the risk tolerance that you feel comfortable taking. So one of the things that I really feel like I can provide is coaching. I think that mentorship through the downturns is really important. One of the worst possible things that we can do is panic and sell in those times. And I think it's important to note that I operate as a fiduciary. So I'm trying to operate with your best interests in mind, where we are going to be placing trades and who's going to be custodying these assets is Interactive Brokers. And this model is an asset under management model. I think with established firms, this actually sort of works against them. The reason being, if you are working with somebody who's already accumulated money, let's say $1 million, just to make the math easy, a typical 1% fee on that is going to be $10,000. So their incentive is in many ways to preserve the capital. When we are starting out with a younger person or somebody that doesn't have much experience with investing, the 1% fee of the small amounts is going to be really, really small. So we are basically going to be aligned incentive-wise to try to grow that money. So really, really quick overview, what is a stock? A lot of people think a stock is a 4 letters and it's this thing that goes up and down, which I suppose is partly true. But we really need to think about it strictly as a small portion of a business. So this is a real oversimplification, but in general, we have companies that are growing and companies that are returning their money to shareholders via dividends. So that's basically taking their earnings and sending it back out to the shareholders. Growth companies typically do not do that because they at least feel that they can reinvest that money and create more shareholder value. So you can, again, this is a bit of an oversimplification, but we can think of these assets as being aggressive or being more conservative. And aggressive assets are going to have the potential for more gains in the future, but we're also going to have more downside risk. So it's going to be really important that we try to mitigate as much of the risk as possible. These more conservative companies or assets, are going to get lower growth, but they'll hold up better in the down markets. And the down markets will be coming at some point. So it's something we really need to plan for. So on the short term, and this is maybe getting a little bit too technical, but on the short term, assets, stocks in particular, are driven by supply and demand, and they're pricing in different things at all given times that they're trading. So this could be new economic reports that are coming out. This could be new rumors about the company. It could be new news about the company. And in the short term, I would say that it's impossible to predict what's going to happen. But over the long periods of time, basically the only thing that matters is the earnings growth of the company. So how much money the company's making. And that's a little bit more, maybe not predictable, but you know what's going to be driving the stock over those long periods of time. So we're really trying to find companies and sectors that are going to continue to grow. And I guess one thing really important to note is that many of these things that we're going to be buying and selling, or buying and holding, are going to be very long-term investments. So we're going to be trying to hold on to these things for 10 to 20 years. And you'll see why in the next slide. What we're looking at on this particular slide is what's commonly referred to as a market index. Oftentimes you'll hear people talking about the market, and in those circumstances, they're often talking about generally this index, but potentially one of the other common ones. And what this is the S&P 500. And it is a basket of large US companies, about 500 of them. And what this plot really shows is from about 1925 to 2025, the growth of the companies in America, so the growth of the earnings of the companies and the growth of the share price of the companies, has been fairly consistent and fairly predictable. So we've grown from on the order of about $10 to about $7,000 where we are today. One thing that I think is quite important to note about this, and a deliberate choice that I made, was to present this as a logarithmic plot. What that means is we're going up in increments of 10. So what we're trying to do is show exponential growth as a linear trend. Compounding is inherently an exponential process, and it's something that we as humans have quite a hard time understanding. And you'll probably see that in a few slides. A pretty surprising example of what would have happened if you invested $200 a month into an S&P 500 market index fund. So, as I alluded to earlier, one of the things that I feel is the biggest pitfall for newer investors is that they tend to get scared. So one of the things that we need to accept when we are buying these financial instruments is that volatility is part of the game. Without risk, there is no reward. And risk and reward are very much tied together. So what we need to do is we need to make a plan that is going to help us get through these times, and we need to plan for the downturns because the downturns are coming. So what we need to recognize, though, is that over long periods of time, we have returned very well in the United States. So our companies have grown, they have become more productive, and overall, we could have a discussion about whether this is true or not, but I believe it to be true. Over a long period of time, we are living better lives in this country. So one of the things we need to understand is that losses feel much more scary and are psychologically more damaging than an equivalent win. So we are really apprehensive to lose, and that's going to be something that sticks with us. We also need to recognize that the media makes their money via clicks and via basically bringing attention to their platforms. And the best and most efficient way for them to get attention to their platform and to get ad revenue is to post scary things. So we're often not going to see the good news, and we're always going to see the bad news because the bad news is going to get more clicks. So it's our job to try to block this out. So what we need to do to combat this is we need to diversify broadly. You always hear people say that you don't want to put your eggs in one basket, because if you fall coming back from the chicken coop, you're going to break all your eggs. So we need to diversify across companies, across sectors, and in my opinion, we also need to diversify temporally. So what that means is across time. And I think a lot of people don't think about it this way, but we'll get a little bit more into that in the next slide. So what I was talking about in the previous slide is diversifying across time. And one of the things that I think is the most successful in making this a successful strategy is to dollar cost average. So what that means is we're going to make a plan and we're going to dedicate a fixed amount each month. So that could be $50, that could be $100, that could be $200. But no matter what is going on in the market, no matter if it's an all-time high, no matter if it's 50% down, we're going to make a plan and we're going to commit to deploying that capital on that fixed time interval. So that's going to ensure that we're not putting all of our money in at the peak, and it's going to really mitigate some of that risk. So when the prices are low, when we're in one of those downturns, which are inevitably going to come, we are going to be able to acquire more shares. So we need to train ourselves to think about it as finding something on the bargain rack. So this is going to take a lot of the emotion out of it for us, and it's going to fit any budget. So like I said, we can start with fairly small amounts of money at first. So one of the most important things is to understand how compounding works. And this is just a quick worked out example of how $200 a month invested into the general market, the S&P 500 index fund, is going to return us over two different time periods, 20 years and 40 years. So over the last 100 years, like we saw in that plot earlier, on average, the S&P 500 has returned 10% a year. So on any given year, it can be much higher, it can be much lower, it could be a loss, but over that whole time, it's been about 10% a year. So over a 20-year period, if we contribute $200 a month, based on the historical data, we would have $151,000. So one of the things to recognize about this is it's not linear. What I mean by that is if we double the time, we're not going to double the money. We're going to more than double the money. So over 40 years, based on the historical trends, and what's happened in the past isn't guaranteed to occur in the future, but we do have historical data over this long period of time. Over the 40 years, we could end up with $1.2 million. So this is a fairly small amount of money each month, and over that long period of time, it can compound into something quite large. So one of the things that disappoints me about our educational system, and one of the things that I try really hard to do as my career as a math teacher, is to try to educate my students about this. I really enjoy doing compounding calculations, and it's really sad that we don't encourage young people to invest more. So the young people have the longest time horizon, and they have the most opportunity to take advantage of owning productive assets. I really think that we should be encouraging more people to do that, and that's one of the reasons that I'm starting this business. So that brings us to the fee structure. As I talked about earlier, when you are working, or when an advisor is working with somebody who's established, in many ways their incentive is just to keep the money from shrinking. So they don't necessarily have an incentive to grow the money. When we are starting from square one, from scratch, you and I are going to be aligned on our incentives. And it's going to be in your best interest and my best interest to grow this money. So how this is going to work is I'm going to bill based on the assets under management. So in the first few years, with small amounts of money, this is going to be a fairly small amount. And in order for this business to be viable, we're going to have to compound out. And I really believe that over a long period of time, if we stay consistent and we follow the dollar cost averaging plan, that we have a good chance to create some wealth and grow the money. So what this is going to look like for the onboarding is, first we need to have an introduction call. So the reason we need to do that is I cannot give you any advice if I don't know your circumstances. So we need to understand your risk tolerance, we need to understand your financial goals, and we need to understand your time horizons. So this will help us select basically how we're going to allocate the money across these sleeves. And after that, I plan to be available really for the downturns when things are going poorly. So you have somebody to lean on who has some experience going through these downturns. And this last slide is just a few disclosures. So this is not financial advice right here. This is just an educational, really introduction to this business and what we're going to try to accomplish.